Okay, so we will get started in about 30 seconds. Welcome everyone to the Data Economics Festival. We're very happy to have you here. We've had a wonderful week of sessions of over 20 sessions. This one on our last day is called How Data Economics Can Enable Embedded Finance. If this is your first session, you can learn more by going to lydion.com/festival. That's lydion.com/festival, where you can find content and information related to the 20 plus sessions that we have had this week. We still have a few coming up today, which should all be very fun. And all of these are about how digital data and economics intersect. We've also had a number of very fun happy hour events, such as a sing-along, golf clinic, and a mixology class that have that have given us plenty of opportunities to have adult beverages, and hopefully you were able to join us for some of those. If not, we will have reruns coming throughout the next few weeks. We are really excited to bring these topics across many sectors where data and economics are intersecting in meaningful ways to you, to such a broad audience as we've had this week. And we would love to hear your feedback on topics that we could present you, other topics that we could present you in data economics, and overall on how digital technology impacts our world and the way that we think about our future. So with that, let's jump into today's session, which is how data economics can enable embedded finance. This session is hosted by Siddharth Brar, and the speakers are SANDIP NAYAK and VIPIN TYAGI. I will have them all introduce themselves. This is a pre-recorded session that runs about 35 minutes. And if there's a Q&A, Siddharth will be joining us in a little bit. And we will also be able to relay your questions to Sandeep and Vipin and get back to you. So please feel free to send your questions in to festival@lydion.com or to me directly at arka@lydion.com. So with that, sit back, relax, grab some popcorn, and enjoy the show.
I'm excited to hear both of you guys speak. So maybe we can start with some introductions.
Sure.
Go ahead, Sandy. Yeah, please.
Yeah, I think so. I have two phases to my career. The first phase is in banking, how banking should not be done. So I was into a couple of big banks, Citigroup and Cap One, where I learned basically products, financial products and channels. That's all you are taught in banks. And then I joined, became a founding member of a startup called Foundation, now Linear. I'm the Chief Strategy and AI Officer, learning the latest phenomenon of Fintech. And there we have been especially in the small business Fintech space. And there I had to unlearn a few things I've learned with the big banks and creating financial products which can reach more people in a seamless fashion, basically using the technology to deliver financial products to wider masses. And having doing that, obviously we run upon the concept of embedded finance, which is the main topic of this discussion, which I'll go in more details. But right now I'm the executive committee member to drive small business products across multiple countries using technology.
Okay, thanks, Andy. Vipin?
Yeah, thanks, Siddharth. Thanks, Andy. My name is Vipin Tyagi, and I'm the CEO and co-founder of VIPIN Chemicals, a clean tech company in the battery recycling space. Prior to starting VIPIN, I had a small career in investment banking with Merrill Lynch, where I was trading commodities out of Houston and Singapore. Sandy is my batchmate from undergraduate, and we have been discussing various things in finance, some opportunities in finance for quite some time. So I thought I have been that this festival offers a very good opportunity to talk the holy grail of finance in the purview of Lydion's view of data economics. I've been fascinated with the work that has been done by Lydion in the last couple of years. The team is phenomenal. Very impressed with the work that has been done. and I've been working with them on a couple of projects. So let's get started on this thing.
Hey man, thanks. Yeah, that's really nice of you to say. But yeah, let's hear a little bit more about embedded finance.
Yeah. So so banking, as you know it, is basically three things, right? The value you wanna store, you wanna store your money somewhere. The value you wanna move around, basically payments, as you know it, right? And needing value when you need it, basically loans, right? So banking is very simple, going by 500 years back. I mean, it is basically those three utilities. I mean, everything else is complicated and derived. Okay, so banking used to be simple back in the day. It was built around utilities when you need it, right? Now, along the way, big banks came along, right? And they created structures around it. Physical banking became our products, channels, right? They define structures of who could bank, where they could bank, and how you could bank, right? I think when you think about your things, right, you have to go to a branch, you have to use these artifacts. Banks will define who can bank. It's not ubiquitous. There's a lot of underserved population out there, right? So the structure has been defined, and that is what I learned in my first two stints in big banks, right? Now, with the onset of technology, right, and that's why I'm intrigued by the data econ technology, how it can usher in more value for embedded finance. The technology is radically eliminating the friction to all the structures banks have created to access the utility, right? Now, if you talk to a customer, they're not gonna say in terms of products or where I have to go. They're gonna say, "Hey, I'm traveling to London. How can I move my money?" Right? That's how I'm gonna pay my bill, right? That's the utility they're talking about. That's the value, right? Now all the structures and frictions have arose. Now embedded finance is nothing but eliminating friction to getting that utility, right? And creating a world where the customer can access this utility wherever they want, whenever they want, right? In whatever form, right? So we're eliminating who. We want to make banking more ubiquitous, more and more people. You want a banking where they are living in their life, right there in their business process, right? And how it should be real time, instantaneous, right? So when you're solving this, eliminating the structures of who, where, and how, that is nothing but embedded finance, right? But embedding the finance, aka utilities we talked about, storing value, moving value, or getting loans, embedding with more people, and at the point of your lives where you are at, maybe through Alexa, maybe through Siri, doesn't matter, right? And in a very, very seamless fashion, right? So that is the basics of embedded finance. So I'll take a pause here, right? Vipin, if you want to add any color, or Sirtaj, if you have any questions on that. Make sense?
Yeah, the one question that kind of comes to mind is, you know, like, is embedded finance inherently consumer facing, or do we also consider like B2B use cases? Because
No.
you know, most of the time when you think of embedded finance, I think of the consumer use cases, right? But it like, but what is the scope of it, I guess?
Now, the scope is, I mean, obviously we have defined again those artifacts that B2C, B2B, these are all defined, right? It is beyond consumer. It is also for small businesses. It is for corporates, right? Even it is for robo investing, right? It could be different use cases. At the core, it is about back to first principles, right? It's the same way Elon Musk designed Tesla or the spaceship, from back to first principles, making it radically simpler. In B2B, right? For example, we can talk about more of these trends. BNPL, buy now, pay later, right? That's a consumer trend in some sense. But because consumer is always ahead of small business because more people invest on it, but BPNPL, which is business buy now pay later, is coming up in the next few months, which is B2B purchase, right? But yes, it is across all products and beyond consumer also.
So, Sandy, I have a question here. So, do you think that this is one of the main reasons that banks are now afraid of big tech?
Yes. So the banks have their own stack, tech stack, there for 30, 40, 50 years, you name it. And the legacy stacks is coming in the way to eliminate any of the friction. They're aware of the frictions, by the way. So that's what fintech has done in the last 10 years, just making them aware of the friction.
Yeah.
They cannot change it. Now, the big techs have a wider distributions. They give other non-banking services and utilities, right? Where finance can be embedded in a big way. And they're starting to. They're already, you see examples everywhere. And that's why you see Citigroup collaborating or partnering with Google to create their next digital bank, for example. That's the reason. That's why big tech is scary. Even in their quarterly addresses, like Rich Fairbank, Capital One CEO, he said, "I'm not worried about fintechs, smaller fintechs like Linear, which I represent. He's more scared about big techs." He says that publicly right now. But you're right.
Okay. So,
Okay.
so do you think basically, so for example, when you mentioned the example of Citigroup and Google, so is it fair to sort of assume that what is happening within WhatsApp ecosystem in the emerging countries, for example, they're trying to integrate payments into WhatsApp? Like, how is that different from what Citigroup is trying to do with Google? Can you please elaborate on that?
Yeah. So Google obviously is bringing in an element which is who could bank, right? I mean, you're trying to make banking ubiquitous, right? Everywhere for everybody at every time, right? In some sense, simply said. And City, obviously, Google has barrier to entry in a financing space which is highly regulated, right?
Yeah.
City has a banking license.
Yeah.
But Google has the ability to make banking ubiquitous, especially from AI, right? And a network, the distribution point of view, which City could never have, right? And creating that modern stack to deliver the services. So Google can really do which City cannot do. And on the flip side, Google can never get a banking license, which is not their business. It's a lot of um, hurdles and regulatory overhead if you want to go through banking today, right? Hence, the partnership makes sense that there are synergies and they complement each other to create their next gen digital bank, right? Which will help City retain a lot of its customers and acquire more customers. And Google obviously is using a tech prowess to add more sources of revenue to their balance sheet.
No, but on the flip side, you see a lot of these non-banking entities, right? They're trying to embed payment structures into them,
Right.
right? So just from that perspective, like I mean, Uber is trying to do it, WhatsApp is trying to do it, right? You just name it. So banking licenses are having the ability to give out bank accounts per se, right? It has limited value nowadays, where the amount of friction by which you can move money between banking accounts is quite minimal.
Yeah, so that is true. So among all the utilities I talked about, right, storing value, the deposits, moving money, which is payments, and loans is the third.
Yeah.
Payment is the least regulated, right? Remember that, moving money. That's why a lot of these big techs are attacking, including PayPal, Square, right? That as the first one, right? Now, having said that, it's not far that these people either to partner with some fintech neobanks like Chimes and Monzos and N2s of the world to get the banking license, which can really threaten the traditional bank, which is already starting to, by the way, right? Or force them to change their experience and friction, eliminate friction the way big techs are trying to do. For example, Uber is basically becoming a bank in the sense that all the Uber credits is nothing but deposits.
Yeah.
Instead of storing my money in the bank accounts, I'm storing with Uber accounts. It's a
Right.
prepaid account basically, right?
Correct.
And that's a big threat. But having all the noise, even it's still very early days in terms of fraction of the true market, but the trend is very strong and threatening the banks as we see it today.
Cool. I think let's now move forward and discuss a specific use case,
Okay.
under a supplier buyer transaction ecosystem, and how embedded finance can sort of benefit this use case.
Yeah, Sartaj, we have, VIPIN and I, he used to be in DC area where I live, right? He recently moved to Seattle last year. And this is where we used to exchange ideas on different entrepreneurship, his business ideas, the work he is doing in Verdun, and I have some ideas in fintech and finance, obviously, whole my career there. And we have some napkin ideas in our closets, right? And this is where, so one of the spaces or areas of finance we have been fascinated by together is buyer supplier business processes, right? It is a very
Mm-hmm.
generic term, but specifically in the market of what we call export financing, right? When he used to travel to India, right, and he has met and he has made me meet some of the suppliers, people in third world countries like India, who are exporting hard goods to places like US and Europe, the first world countries, right? That whole process, I call supplier or exporting process, is full of friction as much as you can imagine. Like this really painful, right? A lot of pain points, right? As more of an academic and a beer drinking exercise, we used to sit in different bars talking about the process and mapping out some of those things, right? So this one is a result of that, right? And it's a and your data econ um,
Mm-hmm.
concept really intrigued me. How it can usher in value. Just for me, it's a learning lesson, right? So without delaying much time, you see some swim lanes here in this picture, right? It's a very simple. The first swim lane is purchaser. Anybody who wants to buy a good, right? In our context, I want this good for whatever reasons. Supplier is the supplier of that good, right? Who manufactures. I'll come to these are the all second order suppliers, meaning these are the vendors of the supplier who help supplier manufacture something, right? And let's call this swimlane embedded financing without naming any fintech company or whatever, right? I think it could be anybody. So it's a very generic framework. And you might know that the process was very simple, right? The purchaser wants something, creates a purchase order, PO, and supplier will receive a PO, right? Purchase order. And basically it has, hey, I want 10 units of X, right? And that will create an invoice, obviously, right? And this invoice is received by the purchaser. Then this is something called approving the invoice, okay, right? And then once the invoice is approved, the supplier will start the process of manufacturing or production, what do you want to call, right? And this is where all the vendors of the supplier will help the supplier, right? For the manufacturing that particular order, you might need some raw materials, some packaging, whatnot, right? And this is where the vendors of the supplier, which we call second order suppliers, will help them. And once the order is fulfilled, it is shipped. In export terms, it is shipped by a true ship, which takes 45 days, as you can imagine, right? And the purchaser or the buyer will receive the goods here, right? And once the goods are received, he makes a payment to the supplier. Now you can imagine first of all, the time axis. The supplier has to wait anywhere between 30 to 90 days to receive a payment, right? And so on and so forth. So another concept of nested suppliers here, meaning the same process you see between purchaser and supplier can be applied to supplier and its own vendors, right? It's a nested loop in that sense. Now let's talk about financing. So this is a natural process which has been happening for many thousands of years, right? The normal trading, right? Today, as I know it, in a traditional sense, some of the financing is happening at this point. There are some different points, which is after the buyer says, I have received all my goods, right? And they're all look good to me, then nothing is broken, right? And that's when between they can send a payment, that's when a financier will finance the supplier, right? And take the money from the purchaser. I mean, so that's one. That's one use case as we see it today. That's also very, it is still with friction and a lot more details. Now, the objective function, right, what we are trying to solve is, can we give the supplier money at this point and at this point, right? Now, there is a famous saying in supply chain finance is the holy grail of supply chain finance is when you can give the money at the time of purchase order, right? There's more risk there. Can you do that? Once you solve that, that's the holy grail. And that's my goal. That's our goal. I mean, it's a win-win-win across the board, right? And the way you do that is obviously using technology and normal fintech stuff, right? Um, so we call it current financing process here. There's a financing. Some people are starting to invoice stage financing, and then there is a whole legal supplier financing. Now, why this is embedded finance? Because this is the world. To your point, it's not consumer. These are small business owners. They live a life, right? This is a process they live day in, day out, right? We don't want them to go to a freaking bank. We don't want them to make a call to a banker, right? And follow 1,000 yards or to just get a loan or have some utility solved, right? What is truly needed, what is embedded finance is in this business process, whether it is embedded in the ERP, in the mobile, or in the shipping systems, whichever it may be, right? Depending on the case, can we have financing available as they're going about their business, right? For example, when case in the point is when the supplier is receiving the purchase order from the buyer, right? Can a banner pop up saying, "Hey, you have been pre-approved for $100,000 line. Do you want to use it for your purchase orders?" Boom, right? I mean, obviously um, the whole underlying data work and everything that has to be solved, and that's the whole beauty of AI and ML and all the operating system goes behind it. But that's the objective. That's what embedded finance is, and that's beautiful. When you're moving from finance 50 years back to modern finance. We call it finance 2.0 today, right? So that's the use case which is I'm trying to convey here, right? I'll take a pause. Vipin, if you want to add some things, or Sartaj, if you have any questions.
So go ahead,
Go ahead,
Sartaj.
Vipin.
No, go ahead, please. That's fine.
I guess the question I want to ask is around so in this case, we're talking about the holy grail of supplier financing. Obviously from a purchaser standpoint, I have no interest. Like, I mean, I'm happy to pay 90 days later, right after I've issued the PO. I want to hold on to my cash as long as possible. But then the financer comes in and if there's some element of embedded finance, whether it's through their app or through their ERP or whatever it is, they also have to have those same banking relationships, right? So they still fall under the or do they? Like, what they must still fall under the same regulatory sort of banking environment, right? And that's kind of what you were alluding to earlier, right? When you're, I'm trying to connect the dots between the Citibank partnership and things like that, right?
Right. So that's one way to solve the partnerships of banks with the, let's say, Ariba. SAP has an Ariba platform which are suppliers, right? The other way is where the big techs themselves, right, here is moving towards banking licenses where you can embed through a marketplace. I mean, there are different structures how you can access financing, where you can build some financing access here, which can be provided by a partnership with a neobank of a tech company, right? If I may. But yes, there is no way currently going around the regulation and getting that license, if I may, to get financing done. Now, payment is a different animal here. Okay.
Yeah, absolutely.
Okay.
You had a comment or question, right?
Yeah, I think no, this is excellent explanation, Sandeep. So basically, if we talk about sort of the actual traditional fintech application here, right? So you'll be looking at some historical data for the supplier, right? And try to do sort of some sort of machine learning algorithms on that, trying to take in various data points from supplier's ecosystem per se, and try to sort of come up with the overall credit profile for the supplier, right? So I think what would be very interesting now is if we can talk about the formation of this whole data economic network, right? As has been proposed by Lydion, Like you can try and create these networks wherein you can create these whole data economies, which you can have private data economies for a particular entity or a
Mm-hmm.
particular person, whatever, right? And these private data economies can share information by, so you can essentially define those market rules by which you and I can trade, right? And I think
Mm-hmm.
that's where this whole data economic framework start adding a lot more value, wherein what you call as your nested second order loops can
Mm-hmm.
actually become a lot simpler to understand. The application of fintech becomes a lot more powerful at that point in time,
Got it.
right?
Yeah.
So, for example, the work that I have been doing with the team at Lydion is around the digital mapping of the value chain. Okay, so for example, if you take any the value chain of any product, as you talked about, there's a supplier, there's a purchaser, then that supplier has its own suppliers. That's your overall network effect that you have to do,
Mm-hmm.
and you can actually trace the materials or the goods that are flowing through this whole value chain,
Mm-hmm.
right? So, for example, in this diagram, it's a very simple one. You can see a supplier can have multiple suppliers, right? He can be importing, he can be sourcing locally, different materials. For the case of simplicity, I just have like material 1, material 2. This could very well have been up to 15, 20, 25 materials, whatever can go into manufacturing of a particular good, right? So this supplier then supplies to this buyer. This buyer then sort of controls its forward chain. It can have some other corresponding buyers in the forward chain, or say, like, for example, let's take for the case of simplicity, it is then distributing its final product using some distributors, dealers, whatsoever, right? So the traceability platform that we have been developing can actually digitally map this whole value chain, howsoever complex it is, and you can start creating these data economic networks between these different entities, between these different businesses, right? So do you think if we have a platform like this, and if you have all the information that is flowing through all of these shared data economies, can it enhance the development or sort of ease up the friction a bit more in developing your holy grail of finance? Could you please shed some light on that?
Yeah. Absolutely. So basically, you are saying, and this is fascinating. I'm also trying to learn the data concept framework as it applies to finance. So basically, and I have a question before I can answer your question is, so you're saying the whole business process can be mapped, right? To where certain nodes can, the data behind certain nodes can be captured, right? And obviously the level of atomicity depends on the rules of engagement, right? How much
Absolutely.
granular I want to go. Okay. Once you
Absolutely.
start
Yeah.
capturing, there is some mathematical framework, some secret sauce, let's just say, which can be used as an input to my financing business process or
Correct.
to give product out. That will be amazing because look, as I said in this slide, this is the base case, right? How the value is being ushered even by fintechs, even by the digital transformations. The financing is still happening at this stage where a lot of things are digitized, the experience is better, but still financing is here, right?
Yep.
Now, if we have access to that kind of data structures through our data network, a couple of things I can see which can be fascinating. We can obviously move up the value chain, which is more margin for embedded finance company, but also a lot of value for the supplier because he's getting the money when he needs the most,
Yep.
right? It's optional for him, but if he wants the money up in the chain, he will definitely pay more for that, right? And it also help his ROI as he's doing business with other vendors. And the best part is the whole market we are creating, where there are suppliers of suppliers, the whole network effect, right? It becomes much easier to find financing points, efficient financing points, because instead of paying him, I could have directly paid the vendor of the supplier the same thing.
Yep.
So I'm making the market much more efficient, and hence creates more value, right, for the whole all the stakeholders ecosystem, right? Um, Now, So obviously there is a level of transparency the way I see, and correct me if I'm wrong, both Sartaj and Vipin. There's a level of transparency and access to the data points across the value chain, right? Which makes the transaction in this case much more real time and possible, right, in the network. I think that would be a step change, a level of disruption to the current embedded financing process as I know today. Okay, so it's pretty cool concept in that sense.
No, you are absolutely right, Sandeep. Sandeep, basically, that one of the main things that you can sort of do with this whole architecture is define the rules of engagement. So that essentially leads to the level of transparency that is required when two entities or two or plus more entities are trying to deal with each other, right?
Got it.
So then you can have the concept of the trust authority. Those rules of engagement can be defined, changed per consensus as the business evolves, right? Those rules of engagement also changes over a period of time. So you can start defining those consensus domains between market players, between the stakeholders. That essentially makes the auditability of this whole transaction chains, right, much more secure, much more faster, much more real time. And I think Surtaj, it might be a good time for you to jump in, sort of, how this is more efficient than a typical blockchain, right? I mean, there's a lot of hue and cry about blockchains nowadays, but I think, I
Yep.
mean, from what I understand, the implementation friction in any company's tech stacks, right, will be a lot less within this architecture as compared to blockchains.
So yeah, without getting into too much detail about specifics, the most common blockchain applications use like a proof of work, requires basically a lot of computation. That's the most common example. There are lots of other examples out there on the market. What we do is something very, very different. And well, I wouldn't say very, very different, but there's not the same requirement of this proof of work where you're trying to guess this number, right? Basically, and just doing guess and guess and guess and guess until you get it. Effectively, what we use is what we call a transactional proof of work. Where it's built upon the actual outcomes, actual things that are happening, whether it's a PO sent and received, right, by two different parties, right? An invoice sent and received by two different parties. Those are actual outcomes, things that have happened, right? Multiple parties can confirm those, and using those instead. And then the architecture itself, basically it runs at the speed of a traditional database, right? So we're not for that reason. There are other things that we do. VIPIN kind of highlighted a few points around what I think he brought up, like a private data economy versus like a shared data economy, where depending on where you are and what level of engagement you want with your partners and things like that, you can choose. Like it is a matrix actually of blockchains, really is what we're talking about. So you can choose to, within your own network, you have your own sort of all your proof points, everything like that. This is my my network, and then outside of that, you can still take those same proof points, and give just the audit signatures, just the encrypted hashes, whatever you want to call them, to someone else, and also give them the encrypted hashes of the version of the program that you use to do it all, right? And then that allows for someone else to have a lot of evidence about what's going on, and then they can even trace. So if you were to then bring in a third-party auditor that was trusted by the party, or it's just their job to audit, that needs to peek under the hood about what's going on, they will be able to see the full audit and make sure that, hey, everything is working as it should be, as it's defined. Yeah. Vipin, there was one more question I think you had in there today.
But so just to respond back, it's fascinating. What you just said, I mean, that's basically the crux of open banking.
Yep.
So the whole crux of open banking is, this is my data, right? And basically today banks have customers' data and using that data they're selling them products, which is like, come on, man, this is my data, selling it back to me and building a product around it. I think what you're saying is this is my data for my benefit. I can share with whoever network I want, right? And that makes things much more efficient, as well as you and consumers get the control back on their data. In this case, the stakeholders are the small businesses, right?
Yep.
So.
Yeah, consumers, businesses, whoever it is, this is definitely one of the things that, forget about just, the specific product, the Lydion product or anything like that. But when we talk about data economics and all of those things, these are some of the things that, that are really at the forefront of what we're investigating and where we have been doing research and all of those things. And, we hope to bring them to light, whether it's our own products, whether it's through partners, through partnerships, through others as well. So, yeah.
Good discussion. VIPIN, any?
No, I think I mean I'm fascinated with this work. So I just thought it was a good idea to have your viewpoint from a fintech expert, how we can sort of utilize this framework. Let's put it this way, right? Into various fintech applications.
Yeah, I mean, Sartaj, I mean, I am moving away, right, from this discussion, much more intrigued and fascinated by data econ framework, right? And would love how some of the fintech use cases can be taken to the next level, honestly, right? And can get more value from this. I would love to at least research on that, right, to start with, and
yeah,
hopefully to build products on that.
Yeah, I think we're going to leave some of these things. Let's leave it for another discussion. Let's have another, we can set up another one, get into a little more detail, and even just explore, what are the opportunities, what are the interesting things that we can do in this space? Because I think there's a lot you can see, like, the whole data economics festival. I mean, we're like covering many other topics, but and we've been working with VIPIN, but the data economics we've seen where it applies in this sort of thing in fintech. We've seen where we're talking about agriculture, we're talking about industrial traceability, we're talking about healthcare, right, and so many other things. But like, yeah, I think there are lots of opportunities here, and absolutely would love to sit down with you and talk about it more, because like that concept that I think that you just got, and I'm glad it clicked for you, is just, it's so critical in all of these spaces, is that the data belongs to you, whether you're a company, whether you're a farmer, whether you're a consumer. We want to make sure that that data is yours, and it's being used in the way that you approve of, that you're okay with.
That's exactly right.
And it's challenging, but it's a challenge worth taking on.
Cool. Fantastic.
Hey, Arka, I think that's the end of the video. Thanks for so much for kicking this off and getting that going.
You are most welcome, Sataj. I will hand off to you for any questions that might have come up.
Well, I guess I'm curious. Did you have any initial comments off the bat, or any additional thoughts that you wanted to share, specifically around like embedded finance, its uses in data economics, whether it's or even just the Lydion platform itself and the use cases that are there?
I think that it was really interesting to see through the session the conversation between VIPIN and Sandy, and the approach that Sandy had of explaining and describing what embedded finance is, and then VIPIN helping him kind of tie the threads together in terms of some of his work with Deco and with the Lydion DEOS. I think that was very, very interesting. And it's clear going back to some of the conversations that we had on Wednesday, and even yesterday with WebHub around the future of the gig economy, it is clear that embedded finance opportunities exist in a lot of very prevalent economic loops. And one of the things I hope is becoming clear to folks who are following along some of these sessions, and it definitely is to me, and it's reinforcing the notion that data economics can definitely help unearth, so to speak, or parse out a lot of that embedded value and help us create interesting products to describe and transact that value. So that was kind of a great takeaway there, is to see how those two very interesting perspectives kind of came together so nicely in a relatively short period of time. You're on mute.
Thanks. It looks like there were a couple of questions from the audience, and I'm going to try to take these. I wish VIPIN and Sandeep were here. I think these would both be of interest to them. But,
I think Sandeep might have been on the session earlier. I think I saw him. Yeah. If he is, then you could promote him.
I don't see him as an attendee anymore, unfortunately. But that would have been great. Anyway, I'm going to just get to the first one. For a small manufacturer, what examples of operational data would allow credit worthiness outside of just pure financial performance? How does the financier cover risk, right? So, I think this is a question that VIPIN would probably be able to answer much better than I could. But if you think about just beyond just financial performance, beyond just profit and loss, if we're trying to determine credit worthiness, one of the couple of things that I think about are the history of like not only just their partners, but like if I'm getting orders and there's my suppliers, my vendors, and that all of the operational details, like my deliveries are on time, right? And my shipments go out on time. Those types of details, if we're able to build those types of models. And even as well, like that's some of the things that Sandeep had highlighted, where he was just showing like the first level, the interaction between two. But he kind of mentioned how, if you could look downstream or upstream and understand that, hey, along through the whole, through, more than just the immediate partners, but even all the downstream partners, if all of those things check out and they're able to assess the quality of the responsiveness and of each player along the way, it goes much further into kind of determining like, hey, what sort of credit worthiness, or how much more likely am I to offer credit to someone at that point. So I hope that makes sense, and I'm sure those guys will have more, and I will definitely going to reach out to them about it. The second question,
I think that's the key, is we definitely want to get back to the audience with answers from VIPIN and Sandeep beyond, but I thought that was a great answer.
Thanks. The second question here is, can a small business collateralize this data of traditional, like instead of traditional assets like land, inventory, equipment? This is actually a really fantastic question, and this has been an area of research for us. The short answer is right now that to do that right now it's very challenging. Businesses very often will get unsecured loans, basically, loans that don't have collateral, with not as favorable terms and such, based upon potential value of their data. But it's not something that, data is not something that a bank or a financier can just take and then resell just like that, right? So it's something that's challenging to offer as collateral. But as we've seen, there's a lot of companies, not just your operational data is worth a lot, but the companies have a lot of other data as well that is potentially worth a lot. A lot of companies are valued based upon their data. So I think there's a huge opportunity to look into to figure out how that can be collateralized and used to obtain, like secured financing, or and all of those things. So that's an area of active research. in an area that we hoped, as the data economics company, an area that we hope to make a lot of progress in. I don't see any other questions. So with that, we can wrap it up here. Thanks to everyone that joined live. I hope you guys saw the session and learned a lot. It was very informative for me as well. And thank you so much for being a part of the Data Economics Festival, and a huge thank you to SANDIP and VIPIN for taking the time.
And thank you, Sartaj, for helping us put all this together. This was a fascinating session. And please let us know, as always, if you have any questions or any other aspects of this topic that you would like to explore more with us at DECO or with our speakers, and we will be happy to facilitate. Thank you so much and have a wonderful weekend.